Good evening, ladies and gentlemen. I'm Sakshi Kulkarni, Director, SME Chamber of India, and I'm delighted to welcome all the distinguished speakers and delegates to this CEO networking meet. Today's CEO Roundtable is the seventh event in the series which we have organized along with UB in the last 1 year. And we are happy to inform that around 50 corporates are enjoying the facilities provided by UB on this platform. I must tell you that all the earlier events have been successful, like today's event. For this, I would like to extend a sincere thanks to the UB team and a special thanks to all of you for being present for this uh, present over here. UB is India's leading fintech company that is transforming the debt market. The company's unified credit platform makes it easier for everyone to access the credit they need to grow and succeed. UB's one of kind product suits offer a wide range of solutions to everyone. As if all of you must be aware about SME Chamber of India, but I will just say a few words about it. So SME Chamber of India is established 30 years back by Shri Chandrakant Salunke, our founder and president of SME Chamber of India, and has been formed with the vision of nurturing and empowering the SME sector. The chamber has diligently worked towards promoting the interest of SMEs across various industries. As a chamber, we offer various support services in areas, businesses, in supply chain, in procurement, as well as connectivity with overseas buyers, joint ventures, technology transfers, and as well as identifying the potential investors also. Our founder and president, Mr. Chandrakant Salunki, is an expert in development of the SMEs with over 30 years of experience, and he is a uh, also today he is not here, so he is overseas, so it is not possible for him to make it today. Uh, as you all are know that SMEs are the backbone of the Indian economy, contributing to more than 30% of GDP, 40% of exports, and 45% of employment. However, SMEs face many challenges in their growth journey, such as lack of access to finance, technology, market, skilled manpower, and infrastructure. To give us a better perspective of the Indian economy, I would like to now invite Mr. Dhananjay Sinha, co-head of Equitas and head of research, strategy and economics, systematic group who is going to talk on Indian economy, key indicators and outlook for manufacturing and service industries. Over to you.
Thank you for the opportunity to speak in this forum. I was not aware that it's only 15 minutes that were allocated. So I did some presentation and all. It's a little longish, but I'll just touch upon the key things that we are talking about. So basically, as far as India's economy is concerned, there is a kind of a kind of rebound that has happened after the pandemic. Clearly, there has been a significant pent-up demand that's been there. A lot of lot of stimulus has been given from the government and RBI through liquidity support, etc. I think the biggest driver for the rebound was largely coming from the fact that I think from the fact that there was a significant global rebound as well, because global economies, if you look at advanced economies, there was a lot of spending stuff that was happening. And also, how do I operate this? So essentially, a large amount of stimulus was given all over the world, especially in developed markets. There was significant, supply shortages that were there. Prices of various things went up, especially commodities, etc. So exports, etc., went up very well. There were shortages, and particularly in the Indian industries, I think all the material-related companies such as metals, etc., metals, mining, a lot of capital goods, etc. Wherever there was a lot of shortage, there was significant spillover from there. Overall, the top line growth of a lot of companies went up significantly, and and because of that, the cash flow for larger companies especially increased quite dramatically. So it has actually permeated across multiple segments beyond the large companies as well. So the cash flow of companies increased quite dramatically, and there was considerable improvement in EBITDA, which is like operating profit and operating cash flow of companies. So that had happened. So I think the lingering impact in terms of how growth has panned out is something that is being talked about. And if you look at the current scenario, FI. So basically, India is the fastest growing economy, as is been touted by many institutions, including governments, etc. So in the FY23, you had a 7.2% growth. This has also had a base effect from previous year. And as per the World Bank, they have come up with a recent note which basically says that India is second highest in the G20 country. It is twice as much as most of the average of EMs that they have considered. What they consider as a major propellant of growth are basically robust domestic demand, large public infrastructure spending that the government is doing, and the financial sector, which is fairly stable. So I think these are the factors that they are saying are driving future prospects. But at the same time, they are saying that there are global headwinds that are coming up, largely because of tighter financial conditions, high interest rates remaining high for longer. There are geopolitical tensions that are panning out, and there is sluggish global demand that is panning out because the bounties that had happened initially as the post-COVID rebound happened globally. Those things are actually waning, and the global demand is becoming sluggish. And they are projecting about 6.3%. RBI is talking about 6.5%. This is still fairly strong compared to the overall context. I'll skip this. These are a breakup of what is being projected. So since we don't have that much of time, I'll sort of skip this and look at the important things. So clearly, if you look at FY, so this is for 2023 and 24, how people are how OECD is projecting India's growth. It is right at the top. And if you look at the average growth, I can't see it. It's actually so basically so world growth in 23 in 23 is about 3.9%, and India is about 6.3 is what they are saying, and the forward projection again it is at the top. So I think this is what the World Bank and OECD is actually projecting. uh, what we find is that I'll skip the global factor, but what is important that I want to highlight here is that as the impact of the stimulus is waning across the world, what we find is that developed markets are actually doing much better in terms of what they were prior to COVID. So if you look at the trajectory of, let's say, household consumption in the US, etc., it has been significantly higher than the post-COVID trend. So basically, household US is actually fairly resilient in terms of how things have panned out, and that is one reason why their inflation is fairly high. And in the recent reassessment that interest rates will continue to be on the higher side. And this is important because we need to do a comparison with India and what it implies for the financial markets in India. Because if you have higher inflation and higher than trend growth, you will have higher interest rates for longer, and you have oil prices going up all across over the world, across the world. So I think that is also impacting the inflation trajectory. So essentially, that translates into a renewed view that interest rates globally will remain higher for longer. And we have seen that risk-free rates across the world has actually surged as as the markets has started to reset in a new scenario that interest rates will be hiked furthermore. So I think that is one thing that is happening. If you look at India, there has been there was a significant dip in the consumption, and there is a significant rebound as well. It has moved above the COVID, but if you look at the trend, what we are trying to show is it's somewhat lower. So if you look at the pre-COVID trend versus now, it is roughly about 10% lower. So there is a considerable scope for this to recover as well. As of now, if you look at the averages pre-COVID versus uh, versus US and now, clearly the average growth, if you look at the 3-year CAGR, is roughly about 3.9% versus 3.6% for India, and US has moved up a bit from 2.4 to 2.6%. So clearly, while our aggregate GDP growth seem to be higher. It is largely driven by a lot of government capex, which is now translating into significant driver of overall growth. Whereas if you look at the household situation, especially if you consider the consumption demand, and we know that recent data has come out which basically shows that household financial savings actually contracted. So basically, the growth is significantly driven by the government initiative with respect to investments in roads, railways, and defense. So this needs to move up. So from there, the impact of that on household income and consumption is yet to pan out. So that is there. Globally, the other trend that we are basically looking at is the divergence in overall trade. The whole uh, attempt by US and other countries to do more near shoring and friend shoring away from China, and the China plus one as an opportunity is happening. But China plus one is an opportunity across the world, and the most prominent beneficiary of that is Mexico. So basically, what we are seeing is that China's share in U.S. exports, U.S. imports, have actually been shrinking, whereas from Mexico it is actually rising. So what we are saying is Mexico is translating into a new China. And if you go back into history, in 80s, Japan used to be the dominant exporter to U.S. and it crisscrossed around 2000, and China became dominant. So what is happening in China is exactly what Japan faced 30 years back. So that, I think, the emergence of of Mexico and other South American countries and Canada and Europe essentially benefiting from French shoring is actually visible now. That's a major shift that is happening across the world. India is also gaining, but India's gain in terms of share in US exports have been much more gradual. Currently, it will be about 2.5%. So it's gradually increasing over the last 10 years. But I think the major beneficiary of this is our Latin American countries, Canada, Europe, etc. So I think there is a big shift that is happening globally. That is also an opportunity for India, but we need to know how much, what is the magnitude of that, and it is not going to come about that way because there are competitive advantage that other countries might gain with a preference that US and other countries might actually give to nearshoring, etc. So this is a major trade switch that is happening, and also having a sort of repercussion of geopolitical politics. As far as global trade is concerned, it's very important for us to understand that global trade is very important for our economy, and it is important for SMEs and small companies as well, because as has been just pointed out, that India SMEs actually contribute significantly towards exports, employment, etc. So global trade is an important thing. We try to look at what is the sort of correlation and sensitivity of India's growth to global trade, and we find that it is fairly high. So every 100 basis point fall or increase in the global trade volume translates into almost like 180 or 190 basis point impact on our growth. So that is an important thing. What we are finding now, based on the global trade data that we've looked at, it is kind of sort of easing out. It's kind of slowing quite considerably. So I think important thing is that while we have this whole China plus one opportunity, etc., but the cyclical factors that are there, as the global bounties are actually coming off, I think that is reflected in our trade as well. So that is that is something that is weighing in the near term. We know that exports have actually started to exports and imports both have started to come off. So that's an important thing. The other thing is financial tightening that we are sort of, I just spoke about. Higher for longer is something that might be there. The key thing is that if you look at the transition in the trade that is happening, it is also translating into lower surplus that China might actually benefit from exporting to US and other advanced countries. So their surplus is shrinking, and their investment in US Treasury is actually coming down. As a result of that, even if the Fed US would want to cut the rate, they would not be able to do that because their deficit and public debt is very high at 120% of GDP for the for public debt. So essentially, what it means is that they will not be able to cut rates, and they might actually want to keep rates higher because the deficit is enlarging now. Over last year, about $150 trillion is what is the current financial year. In the first 11 months is the fiscal deficit. That's almost like 60% higher than last year, and it could rise to 180 trillion dollars as well. One, yeah. So that is something that will ensure that the interest rates might actually be on the higher side. So that might permeate into Indian yields also rising. So 10-year US Indian yields have actually gone up to 7.25%. US yield over the last 3 months have gone up. 10 years gone up by 130 basis points. So that is something that is happening just now. And because of this, the dollar is actually strengthening, and as a result, the RBI is also so rupee weakens, and RBI is actually selling reserves to prevent the rupee from depreciation. So that is a fiscal spillover, that is a financial spillover that is happening, and rupee might sort of depreciate, and the liquidity might tighten. So the short-term rates have actually gone up more than the long-end yields. So the short-term yields have actually gone up. So that's an implication over there. As I said, global savings is decreasing across most emerging markets. The reserves have actually fallen, and China and Japan put together, their investment in US Treasury has actually declined by almost like $300 billion, $400 billion since January 2022. So I think that is happening as a spillover effect of the global tightening. As far as geopolitics is concerned, what we find is that the commodity prices fell last year, they softened, but now the oil prices have gone up again. So if you look at it, there is a sort of tug of war that is happening between Saudi Arabia and US. Basically, US is trying to run down its strategic reserve to cool the crude oil prices. Saudi Arabia and Russia is actually constricting that. That is actually pushing up the oil prices close to $95 or $100 or thereabout. And it will have a spillover effect on some of the commodities such as agriculture produce, metal prices, etc. That can happen. So I think this is what the geopolitical thing is translating into at this juncture. So the softening in the crude prices translating into lower inflation in the US and other countries is actually having is kind of reversing because of this geopolitical thing that is happening. India's corporate profit. So if you look at the Nifty profit, EPS have actually shown that red line that you see is a significant jump in the profits of Indian companies, especially the large cap companies represented by the Nifty companies. That has increased by an average about 15% CAGR from the pre-COVID level. So almost like almost like 50-60% higher than the pre-COVID trajectory. That red line is the EPS of that, and that's kind of flattening at the end of it. But what has happened because of this is that the markets have actually responded very strongly in terms of the rebound. But what we are finding now is that over the last 2 years, if you look at the large cap companies, that has actually become stagnant. So Nifty, for instance, for the last 2 years, have given about 6% return, which is 3% annually. And if you look at Bank Nifty, for instance, it's a very significant part of the overall market that has given 4%. So after a significant rise that you see, there has kind of been a flattening. But what we have seen recently is that the small cap companies actually done phenomenally well, and that largely because there was a demonetization that happened and FPI flow momentarily came in. So there was a large liquidity that happened. And typically when there is demonetization, etc., when liquidity expands, it typically benefit HNIs, put money in the market, and the small cap rises very rapidly. So for the last, I would say 6 odd months, more money has come into the small cap names, and so that is actually translating to significant rally out there. But the large caps are actually stagnated. If you look at the profit growth, the EPS growth at the end of it, on average it rose by 26%. The average is there, but that, if you look at the trailing basis on it, has actually decelerated to 3.5%. So essentially, there is a dichotomy between the large cap profit growth and the way the markets are actually behaving, especially with respect to the with respect to the small cap company. So I think that is something that is worth noting with respect to the market's performance. So that is an important thing. What I just wanted to focus also on the small companies versus large companies thing, what we are finding is that the share of in most of the industry, the share of the smaller companies actually come down, whereas the large companies actually gone up. So if you look at this one, first two charts that we have actually shown is with respect to FMCG companies, and this is relevant across multiple sectors. And if I have drawn the volume growth of FMCG components from the IIP, you see that it is actually zero or negative for most of the time over the last, I would say, since the pandemic. But if you look at HUL, for instance, which is a big name in the FMCG pack, it has actually seen a positive growth despite the fact that they have actually grown in terms of market share. Their volume growth is just about 3.5%. And 10 years back, it used to be about 7.5%. But if you look at the how they are drawing their profit, the price increase, the realized price that they get has increased to almost like 11% on a CAGR basis. So large companies are actually benefiting from higher top line and higher pricing power, and that translating into higher profits, whereas the overall industry might still be contracting. So essentially, what it means is that smaller players might actually be seeing a lower volume growth, maybe contraction as well. So I think that is there, and this chart basically, the last chart basically tells you how the pricing power of large companies has actually increased. So whosoever has got monopoly, has gained significant markup with respect to the cost. So basically, that has shot up quite a bit as far as corporate performance is concerned. Talked about the household income and consumption. So I've looked at the 4 year CAGR of household consumption and income since 1950s. This is almost like 70 years trend and a 4 year CAGR. Essentially, there is a rebound in the consumption. But if you look at the income, which is basically net out of the saving, so as I mentioned, the savings have actually contracted. So you add consumption plus saving, you get what the income is. So essentially, that income has actually slowed quite dramatically. So which means all the retail lending that is happening, which is growing at something like 20%. MSM, if you look at the NBFCs, the lending is growing at almost like 30% plus. So a lot of that is going into retail lending. Essentially, what we are highlighting is that a lot of demand impetus that is happening from a consumption standpoint, be it two-wheelers, four-wheelers, or all kinds of leverage consumption, credit card lending that is happening. It is essentially making good for the lower growth in income. So essentially, there's a lot of leverage consumption that is happening, is what the data is telling us, and hence the net financial savings, as has been recently released by the RBI, it's actually contracted by 18% last year. These are indicators relating to services, etc. There was a big bounty that has happened as far as India service trade, etc. If you look at the CV volume growth, it actually picked up quite rapidly, but it's kind of picking out at this juncture. Railway freight, and if you look at major ports, cargo, etc. I mean, they all rebound, but I think they are all kind of flattening, is what it appears at this juncture. But as I said, government capex has been a major driver, and this has been the significant factor driving our growth. And in the so basically on a 4 year CAGR basis, growing almost like 25-30%. A lot of this traction is showing up in roads, etc. And any industry that is linked to equipment supply, etc., is actually growing very rapidly, and that shows up in the sectoral allocation as well. But if you look at the government consumption expenditure is actually contracting. It's very modest after the significant stimulus that they gave initially. It's starting to contract. So basically, there's a expenditure switching that is happening as far as the government is concerned. Opportunities essentially lie in leveraging from the government capex that is happening. So that if you look at the first quarter this year, the RBI said that state governments have actually expanded by 75% year on year over last year, and central government expanded by almost like 50%. So an average about 65% in nominal terms and 64% on a real term basis. So that has been a major driver for our growth right now. There has been so this whole thing about private capex, whether it is picking up or not. I think this story I've heard over the last 10 years, and several times we have seen people talking about turnaround in private capex, etc. There has been a significant increase in the intent by various companies and industries that has been shown, but the conversion of that in terms of how it translates into actual investments is actually been much more modest. Roughly about on average about 16-17% is what is translating. And so that is what is, so private capex I would say is still languishing. It is still elusive, I would say, despite a lot of hope that has been there. Here we talk about agriculture. Agriculture has actually been doing very well over the last uh, 4 years. The average growth is almost like 4%. So that has been there, but the recent situation with respect to monsoon is something that is concerning. But the important thing is that the reservoir level has actually expanded over the last 5-6 years, and as a result of that, the capacity to hold water, etc., in various reservoirs that is there has increased. So the risk is that if that doesn't get fulfilled entirely, I think there can be some issues out there. But it appears that investments in reservoirs and also expansion in the irrigation facility through tube wells, etc., that has been expanding very well. So I think there is some resilience out there, but I think there is definitely a concern with respect to the near term shortfall as far as the monsoon is concerned. So overall, I'll sum it up. Basically, what I'm saying is that yes, we the headline numbers look very good. I think the contribution of growth comes from a significant expansion by government spending as a percentage of overall domestic spending. It is roughly about 10 odd percent or 7 odd percent of the total spending that is driving a lot of GDP number, headline GDP number, and hence we think that if you look at the private sector, which is household, and if you look at the private capex, for instance, that is actually lagging, and unless that really comes about in a significant manner, this rebound is something that cannot persist for long, given the context that global headwinds are there. So I think what we await is a revival of the private capex, etc., and household confidence, etc. The government has told that there is contraction in saving is a reflection of better confidence of household. We have seen a lot of those things coming in social media, etc. We don't agree with that. So we need to have higher income growth that comes with higher investments, industries investing in the capacity expansion, etc. That will be most important. So I think the headline number should not drive complacency, is what we are saying. There is significant fiscal dominance, as I said. Household situation is still very fragile, as I just showed in terms of the income growth. There's a lot of leverage expansion, consumption that is happening. Post-COVID bounties for corporates, large corporates, has been very strong. Smaller firms, it has to translate into migrate towards smaller firms. Private capex, as I said, has been elusive. Global bounties are kind of coming off because of the trade data that we talked about. Government is doing heavy lifting to support the demand and largely into capex. What we are saying is that we need a macro policy facelift. Important thing in our thesis is that the government should actually lower the indirect taxes. The current level of indirect taxes is highest since 1988 because the fuel prices, etc., has been increased. GST expansion, for whatever reason, the incidence of indirect tax, including GST, including custom duty and all kinds of tax, if you look at it, net of subsidy, it is at the highest level at 11.1% of GDP, and that the last time we saw this higher than this was in 1988. So we need to bring that down. As you bring that down, you have better disposable income, and it will start impacting demand, etc. So you'll have endogenous growth in revival in demand for household, and that will translate into a sustainable top line growth and the confidence of companies to go ahead and invest. The strategy is largely been that you give a lot of supply side stimulus through corporate tax cuts, etc., and this whole hope that as you do more infrastructure spending, companies will come and invest is not really working because the demand side is not so strong, because you're there on the other side you're increasing indirect taxes that is impinging upon the household. So basically we want to reverse that. We need to we have suggested that while we are sort of investing a lot of infrastructure sector, that is good, and you have done a lot. I think we need to focus a lot on encouraging small industries which are dominant players in employment generation, income generation. Services sector, we have mentioned some sectors out there which can be so there are low hanging fruits which can be addressed very quickly. And on the last one, we are saying strategically, this whole strategy that we should actually evolve national champions, very large champions that will drive growth, is not really beneficial because it actually encourages more monopoly, and it actually discourages smaller companies from investing. Because if you know that there is dominant player in every industry, the smaller players will not be so encouraged to invest, notwithstanding whatever stimulus you give. So that is something that, from a policy standpoint, needs to be addressed. I don't know how it can be addressed, but that is a pain point, according to me, for the country to evolve indigenous, sustainable demand growth and growth as well. So I think that's where I end. So it's kind of a mixed. There's a lot of India shining kind of a thing that is going on. But I think if you look at the micro level data, it's quite different, and those things need to be addressed for you to sort of sustain a sort of to have a higher growth, because these headline numbers can be sometimes misleading. So I'll end there. If there are questions, I'll be happy to answer. Yes.
So as you mentioned that crude oil is increasing,
Yes.
and while the Indian government has been focusing on manufacturing, the
Yes.
impetus has been on manufacturing, and that
Yes.
can be seen in the GDP numbers, right?
Yes.
But there are certain global factors probably which might affect the Indian economy. Uh, U.S. Treasury yields, and I think one of the major things is the crude oil, which you I
Yes.
think mentioned in the
Yes.
presentation. So I wanted your insight on assuming that crude oil increases down the line in the next
Yes.
6 12 months, right?
Yes.
Goes beyond $100,
Yes.
$110. What kind of, given the current inflationary environment in
Hmm.
India, what
Hmm.
kind of impact are we seeing on the economy, and specifically on the mid and and the small and mid companies in India?
Yes.
And is there anything those companies can do to brace the impact?
So I think, historically, if you look at the sensitivity, rising commodity prices and oil prices typically has a positive correlation with the demand side. Typically, long term, if you look at it, higher crude price comes with higher growth and higher demand. That's not the situation now. So typically, long term, I would say it happens with higher top line growth. Companies do benefit, everybody benefits, and there is increase in compensation, etc. That ideally happens. But in the current scenario, given the context that the overall demand is fairly weak, and if you look at top line growth of non-finance companies, actually zero on a year-on-year basis. So basically, what would happen is that, so what is happening in the current scenario? Before the increase in crude prices, people were benefiting from margin expansion. They're focusing on conserving cost. And as a result, while the top line was actually flattening, they were expanding the EBITDA margins. And that was happening significantly for large companies that had gained market share. So for them, there is a disproportionate increase in profits. But if you look at when commodity prices fall, the market share gain that large companies have got, that will start wearing off because smaller companies will become more viable, and they come up and the competition increases. So that is why they cut prices, they compromise on top line price increase, etc., and they pass on the margin expansion. So margin expansion becomes a very important thing. Now, if the crude prices go up, now what will happen is that the cost pressure will start to rise. So margin will start to compress because top line is not really growing. So the margins will actually compress. As that happens, the benefit that small companies would have had with lower cost will actually go away. And because post COVID, the market share gain of large companies have been significant, they will again sort of start gaining market share because smaller companies will start getting the impact more adversely than large companies. Large companies have more levers to actually play around, so they might actually. So basically, it will be a adverse impact on smaller companies relative to the larger companies, because large companies will be able to increase prices. Smaller companies will not be able to, fend against the increase in cost if that were to happen.
Thank you.
So, I mean, there are a lot of stuff I have not been able to present. Any other topic, etc., that you want me to respond to beyond the presentation that I've made? I'll be happy to answer after everybody has spoken.
Okay, thank you. Thank you very much. Thank you, Mr. Sinha, for giving us more inputs on the global economy, and it was a very good speech from your end. And uh, As we all know that we have just conducted, the India has just conducted the G20 summit, and we have received the very good response from most of the world. And now the India, they are looking as a growing market and planning to invest in India. So we should say we are thankful that we are having our Prime Minister Modi's what he is looking for, and we can try and help from the SME sector to achieve that. So now to achieve those things, the one of the most critical challenges is the access to capital. So this gap hampers their ability to invest in new products, process, equipments, and markets, and limits their potential to create a jobs and wealth. To bridge this gap, SMEs need to explore various sources of funding, such as bank finance, equity, venture capital, and supply chain finance. To address this challenge, I would like to invite Mr. Harish Biani, Deputy Vice President at UB, formerly known as Cred Avenue, who is going to talk on scaling business with new supply chain financing structure.
Thank you. Good evening, one and all. Thank you for your time today evening. It's a pleasure, to be a speaker in this event. So, so today, I would be talking about, what is UB. I will be, briefly speaking about that. How are we enabling credit flow in the Indian market across enterprises? And what we think about while UB is into, all things debt in India. But today's focus will be supply chain finance, as this directly impacts the supply chain of, enterprises, right? Both upstream and downstream, and specifically, how it enables how our platform enables various SMEs, uh, and what we think about digitization in this space, right? Um so I'll just start. I'll just briefly introduce about UB. So UB is India's first and largest marketplace for enterprises to raise debt through the use of technology. To give you a brief background, this company was, started by Vibhuti Capital about 7 years back, and this company chose to focus majorly on technology to enable credit for various enterprises by the use of technology. Um, in the last 3.5 years of operations, we have enabled enterprises, including, large enterprises, mid corporate enterprises, small corporates, and even SMEs, to raise cumulatively about 1,000 crores, 1 lakh 1,000 crores of debt over the last 3.5 years. Uh, Currently, we offer about 25 plus debt products, and this encompasses all the debt products that are available in India, including new products that we keep innovating on our platform. And currently, on a daily basis, we power about 1 lakh to 1 lakh 30,000 transactions per day through our platform. Uh, we raised our Series A about $90 million 2 years back, 2.5 years back, and about $137 million Series B 2.5 years back, 2 years back from some marquee investors. Uh, so what does UB primarily do? UB is a marketplace where we have lenders on one side and borrowers on the other side, right? And UB primarily connects these borrowers and lenders together on the platform and uses technology to deepen the credit market. Uh, Lenders are, have supply of capital on one side. They are looking for, one-stop solution where they can, invest their capital, and on the other side you have, borrowers who generate demand, right? And we kind of connect both these parties together using multiple tools on a platform, which I'll talk about later in this presentation. Think of us as a marketplace like Amazon or Flipkart, right? For example, if you take Amazon, you have about thousands of sellers on one side. If you go on Amazon, you can see always that, sold by, let's say, XYZ or ABC enterprises, right? So the number of sellers would be about in thousands, but the number of buyers would be probably 10x or 50x of that, millions of customers, right? So UB is similar to that. What I want to cover here is, in our experience. So this company was started by ex-bankers, who have about, 3 decades of experience in banking. And when this company was started by them, there were certain, barriers that they identified, in this enterprise debt market, and which we are trying to solve on this platform. One is limited access to affordable capital, right? Now there are various spectrum of companies in the market, right? You have companies who are rated AAA, large corporates like Reliance Industries, the Tata Group, the Birla Group, etc. You have mid corporate companies, who have small corporates, and you have SMEs, right? Uh, what we have seen is that not all companies have, clear and efficient access to capital. Uh, Companies that have access to capital, either it's not properly structured, the interest rates are high, etc. So what UB does is that UB enables a company to interact with 750 lenders, 750 plus lenders in India at one go, right? When you interact with this many number of lenders, obviously not one company might not interact with 750 plus lenders. Our platform uses some algorithms to tell you that what lenders are suitable for you, depending on your profile, depending on what your product requirement is, right? You can, at the click of a button, interact with potentially 20, 30, or 40 lenders at once. When so many lenders are engaging with you at one point of time, it always results in better terms for your enterprises. It can be in the form of commercials, rate of interest. It can be in the form of better structuring, uh, or or something that you want to change in your overall debt profile, probably consolidation, right? Uh, High interest rates I already talked about. So what we have typically seen is that entities who come on a platform have been able to reduce interest rates starting from 50 bips to about 200 bips, right? Obviously, I mean, companies who are on the higher rating spectrum, they have been able to reduce their interest rates about 50 to 75 bips. Companies in the mid segment as high as 1% to 2%. Collateral requirements. Uh, Not even, I mean, we all know for a fact that SMEs are not able to grow. They are not, even though we talk about how various banks, etc., enabling credit for SMEs. But we know that it's a tedious process for SMEs to go to a bank, and raise capital. I know for a fact that SME would probably go to a bank multiple times, and would get a loan sanctioned in about 30 days or 60 days. It's still that tough. Thanks to the government, we have certain online platforms like online PSB loans, etc., which are solving for this to a greater extent, but that also is to limited to certain quantum and certain products. uh, we have seen this in larger entities also, where multiple companies who are where turnover is 1,000 plus crores as well. Collateral becomes kind of an issue for these companies as well, and this becomes an issue for them in further funding their working capital for growth. What UB has been able to do is that structure multiple products where on an unsecured basis we are trying to deepen the credit market, and there are lenders who are actively participating on this product on the platform. Lack of credit history. Multiple SMEs, you don't even have credit history, and there are certain lenders who wouldn't even lend to the SMEs without this credit history, right? Uh, SMEs would need to have a bureau score, etc. Which there are. It is estimated that about 25% of SMEs in India are -1, or that means in bureau terms are -1. They do not have any credit history, and these are the SMEs who are most underbanked. They do not have access to easy capital. This is where our platform comes in, with the support of anchor corporates, enterprises like you, uh, and multiple partners or banks. We enable easy capital to these SMEs on a platform. Limited awareness of financing options depends on companies to companies. Some companies are aware of what kind of financing options are available. Some are not. Uh, debt market in India keeps evolving. Yesterday we have certain product, today we have a new innovative product, and companies are not aware about that. Lengthy approval process. Even today, be it except for certain retail loans like credit card or unsecured business loans, right? Most of the loan sanction process is offline. For a bank and NBFC, a simple working capital requirement for an SME or even a corporate might take, for full to full closure, end to end closure might take 2 months. Right? What we are trying to do is that through the use of technology, and by directly integrating with vendors on the platform through multiple APIs and providing this infrastructure, we are trying to reduce this turnaround time for our enterprises and customers. We have seen that typically enterprises are able to reduce time by about 40 to 50% when they come and access our platform. So we talked about what kind of challenges we have seen in the SME space and for the enterprises, in the Indian debt market, and what is the possible solution that we are trying to provide or offer these companies. It is a UB credit market where we have, as I mentioned, we have lenders on one side and borrowers on the other side. On the UB platform, you have any borrower who comes and register on the platform has access to about 750 plus lenders. This is your private banks, foreign banks, PSUs, NBFCs, fintechs, offshore funds, credit funds, mutual funds, insurance companies, etc. And of course, this lenders, the kind of companies they want to access, that will depend on the size and nature of that company. And we have about 3,000 plus enterprise borrowers. We While UB is present in multiple business segments, for example, loans, where a company can come on a platform, raise a working capital debt, raise a term loan, raise a project funding, or can just consolidate its debt. We have bonds for the higher rated companies. A higher rate company can issue MLD. It used to happen in the past, but thanks to the recent loophole plugged in by the government, this is no longer an option. But raising bonds or commercial papers to our platform. And then we have supply chain finance, which caters to all the companies in the rating spectrum, right from a Reliance Industries to a Tata Motors to a smaller company having turnover of even 100 or 150 crores. Right? And this is where we see a lot of potential. And I would be spending the next 10-15 minutes or so to walk you all through what UB is doing in this space to enable easy access to capital for enterprises and solving the supply chain problems. I'm sure every enterprise here must be using trades as a platform, for dealing with their vendors, MSME vendors, right? UB is a non-trades platform. In a span of 3.5 years, we have been able to become the largest non-trade platforms in India. Uh, Specifically for supply chain, we have about 25 odd investors. This is a combination of banks and NBFCs, banks, PSU, private and foreign, and about 150 odd anchors on the platform across multiple sectors. We are currently catering to about 12 sectors in India. Uh, about 1,000 dealers and vendors are registered on the platform, and we cater to all companies right from AAA to unrated. Right? And currently, in the last year or so, we have disbursed about the throughput that we have seen on the platform on the supply chain platform is about 3,000 crores. I'll give you an anecdote. So we signed up with Vedanta about 18 months back on our platform, and Vedanta has been able to push 2% of its sales, through our platform. That translates to about 1,700 to 1,800 odd crores. So just imagine the impact on the SMEs. Vedanta has been able to grow its sales by this much amount, and the impact it has created through its entire supply chain. This is mainly on their distributor side. uh, what kind of value add this platform is offering to multiple enterprises and lenders, right? First, I'll talk about the products. On the supply chain finance, typically you have 5 to 6 products that the enterprise can use, and with the lenders that are offering. One is your sales bill discounting. It is a product to uh, cover your receivables, to optimize your receivables. Vendor financing, where you help your vendors, where you help your vendors uh, for their early payments. Unsecured purchase invoice discounting. Again, this is a program for your purchase side of supply chain, where the anchor corporate or the enterprise themselves take a loan, this unsecured loan, and supports its vendors on the platform. And we have classical tier 1, tier 2 dealer financing. Again, this supports your dealer leg of the supply chain, and factoring as a product. On the platform, what happens is that, as I mentioned, since it's a digitally operated platform, the turnaround time is very quick. We have seen about 40% reduction in turnaround time, right from when a corporate signs on the platform to the final disbursement and further execution. Uh, what we have seen is that supply chain finance can be a very operational heavy process for a lender as well as corporates. To solve this, what we have done is we have directly integrated with the lenders. For example, Indian Bank, Shinhan, let's say Pune or FinCorp, we are directly integrated with their LOS and LMS. What happens is there is seamless flow of data from our systems to their systems. Of course, subject to the approval of the enterprises who's coming on the platform and subject to the approval of the lender as well. This significantly helps in reducing the turnaround time for various operation activities. Similarly, for the enterprise, right from creating a program, sanctioning a program for their dealers or vendors, onboarding the dealers and vendors, doing their credit decision making, final disbursement, and managing the further discounting of invoices, setting up the limits, monitoring of the limits. This is something that is taken care by the platform itself. uh, Supply chain finance takes care of your also helps the enterprises to improve your top line and bottom line. For example, dealer finance can help you deleverage your balance sheet, uh, put the risk of receivables from an enterprise to your dealers. Right here, the lender partner which will come in on the platform will lend to the lender, will lend to the dealer, and the receivables will move from your balance sheet to the lender's balance sheet. Uh, this is how you are de-risking your balance sheet, deleveraging your balance sheet, and also it helps you to realize your collections faster, resulting in a faster DSO. What I'll do is, I have been talking about a lot of tech, etc. What we have done is that we have created a short video on how this platform actually works. This shall give you a lot of insights about the platform.
Meet Mohit from Future Motors, leaders in automobile manufacturing. 4 brand new cars roll out of Future's assembly line every minute, for which Mohit's role as procurement head is critical. Future has a massive supply chain network. Mohit and team have to ensure that the 1000 plus components that go into Future's cars arrive on time every time from their extensive supplier network. Then there is Riaz, the sales head, whose sole focus is to ensure that Future's dealers are buying and selling more. On the other hand, Monica, Future's CFO, has the challenging task of managing working capital requirements of Future Motors and keeping debt levels under control. To optimize working capital, Monica expects a 60 to 120 days credit period from suppliers who need money on day one. Monica also expects that dealers pay upfront for delivery of Future's cars. This could potentially strain the relationship between Future and its suppliers and dealers. How can Future balance its own working capital needs with the needs of its suppliers and dealers so they work like a well-oiled network? Enter UB Flow, the most flexible and advanced supply chain finance platform for corporates covering various sectors across credit ratings. The platform's guiding principle is that supply chains are heterogeneous and therefore capital needs to be aligned at every risk and price point from multiple financial institutions. UB Flow's dedicated relationship manager helps onboard Future Motors on its platform in a simple and efficient manner. Subsequently, Future creates a vendor finance and dealer finance program on the platform specifying a few parameters. Now UB Flow's AI matchmaking engine gets to work. It ensures that Future's supply chain finance program is visible to the right financial institutions from among its vast pool. Mohit and Monica are spared the effort of chasing multiple financial institutions to find the right partners. They receive competitive proposals with desired terms. They soon find the right partners in Glowbank and others. Future's program now goes live. In just a few days, bulk of Future's suppliers and dealers are on board. Suppliers start uploading invoices on the platform, which are automatically processed, and in less than 24 hours, they receive their due payments. On the other hand, dealers start placing more orders with Future and Future gets its sales proceeds on day one. Future Motors, their suppliers and dealers are delighted as all of them get an injection of working capital in no time and without any hassles. The UB Flows platform's automated invoice processing and customized dashboard with critical data points help Mohit, Riaz, and Monica strengthen their relationship with suppliers and dealers while freeing up their time to focus on other important matters. Since Future is able to negotiate better interest rates, they pass on some of its benefits to their partners. With UB Flow's supply chain finance solution, Future Motors not only solves its working capital requirements but also gets many other benefits. It ends up deleveraging its balance sheet, extending days payable outstanding, reducing days sales outstanding, improving its rating, improving its profit margins, increasing sales, and attracting the best suppliers and dealers. UB Flow, cash flow optimized.
Any supply chain for an enterprise is not homogeneous, it's heterogeneous, right? What that means is that none of your dealers are same, none of your vendors are same, right? And a single lender cannot look at your dealer or vendor at one lens, right? What you have seen is that companies, what typically do is that they will engage with one or two partners, lender partners, and this leads to one-to-one singular conversations between the enterprise and the lender partner, and it covers only 10 to 15% of your supply chain. Essentially, for an enterprise, it is very important to cover at least 80% of your supply chain to actually optimize these benefits that we talk about. What happens is, on the platform, when lenders come on the platform, capital is aligned at every risk and price point, and lenders will accordingly, price the risk on the platform. For example, your dealers who have a good credit history, dealers who have a good vintage with the enterprise, thank you, with the enterprise will typically see, getting good competitive rate of interest from the top tier banks. And there are certain dealers, as I mentioned, would not be having some credit history at all. And top tier banks would not be willing to lend to those dealers. But there are certain other lenders, who would be taking a call for that risk, pricing it accordingly, and would lend to that dealer, right? So, it is very important for companies to ensure that you have a segment of lenders covering your entire supply chain. One lender will never be able to cover your entire supply chain. There are three major supply chain finance products, while there are multiple sub products, and we can discuss on that. Uh, One product that we are seeing, which has gained a lot of traction in the last 2 years, is unsecured working capital solution for the anchor corporate or for the enterprise, right? This product is called purchase invoice financing or purchase bill discounting. It increases balance sheet capacity completely of the enterprise and helps enterprise to manage its vendors or working capital very efficiently. Typically, lenders will directly fund the vendors, and on the due date, let's say 60, 90, or 120 days, will collect the payment from the anchor corporate or the enterprise itself. Uh, then there is your classical dealer finance program, tier 1 and tier 2 programs, which covers your distributors and dealers, which kind of increases your sales, helps to improve your deleverage your balance sheet, and also helps to increase your reduce your debtor days outstanding. And on the other side, which is on the procurement side again, this is a vendor financing program, which helps to pay your vendors regularly, give support to your vendors. A lot of these vendors in this country are MSME. About it is estimated that every enterprises, right, 250 crores and above enterprises, uh, 46 or 42% of their sales comes from MSME vendors, and MSME vendors are always strapped for cash. Vendor financing programs helps MSMEs to get cash on time and churn the working capital to ensure that the corporate is getting the desired raw material or desired product in a convenient time. So for vendor finance, typically helps a company to get sourcing advantage from your competitor. Through vendor finance, funds are secured for your vendor, and whenever there are shortages, right? There are situations where there might be very high demand for certain type of materials, etc. Having a vendor finance facility can help you get an edge over your competitor, because you will need cash on day one to secure those materials from the vendors. It extends your day payable outstanding. Enterprises can also negotiate cash discount with their vendors. Uh, as enterprises are tying up with lenders to ensure that their vendors get payment on day one, right? Enterprises can negotiate cash discount with those vendors as well, and this directly adds to an enterprise's bottom line. Similarly, on your channel side, on your sales side, as you know, we talked about, it helps to deleverage your balance sheet as the lender who is coming in, who is doing that program with you, is assuming the risk of those receivables now instead of you. It helps to reduce your day sales outstanding, and it helps to increase your sales. SME, while a dealer distributor might be, let's say, purchasing 50 lakhs a month or 1 crore per month from you. He might have the appetite to probably do 20 lakhs or 50 lakhs worth of more sales every month, but he doesn't have the working capital. Through the solution, you can always push sales to that dealer, and increase your sales as well. How a supply chain finance product works. uh, this is the summary. uh, Enterprise comes on a platform, registers, creates a program. For example, you're interested in a dealer finance program or a direct balance sheet program or a vendor financing program. You create that program, you complete your profile. uh, Once you complete your profile, the system comes into action. It will analyze your profile, it will analyze your requirement, and the algorithm will use this data to match you with suitable lenders. So typically what we have seen is that enterprises typically receive about 4 to 5 minimum interest from these lenders, suitable lenders. That means, you don't have to randomly go to a lender for your financing needs. The system tells you that which lenders are relevant for you, and it will be a minimum of 4 to 5 lenders that can you can engage with those lenders at a given point of time. You start receiving interest from those lenders, and depending on your approval, you can decide which lenders do you want to interact with. You can also decide that if you don't want to show your profile to a particular lender, you can always hide that. The sanctioning process starts. Negotiation happens on the platform. You accept term sheets and get the program live. UB team, of course, is involved in the entire process. Once the program is set up on the platform, your dealers and vendors are invited on the platform. They are registered, they are onboarding, credit evaluation, etc. Everything is taken care by UB. Lenders will use UB's platform for all those decision making process, and your vendor dealers will go live. Once your vendor dealers go live, they can just come on the platform, upload an invoice, upload a purchase order, and raise the request for discounting. And that's when the disbursement happens. And post disbursement, the entire monitoring which has to be done, which I was talking about, the enterprises will get dashboards to monitor the limits that you have set for your dealers and your vendors. These are some of the lenders that we work with. For example, Indian Bank. You would see a lot of articles. Recently, we have signed Tata Motors with Indian Bank through our platform, mainly on the channel side. Uh, Yugro, Bajaj, Poonawalla, Shinhan, Vivriti, etc. Recently, we have signed a 5-year exclusive contract with SBI for our co-lending platform. Uh, Very quickly, just to reiterate, the value proposition. You get to interact with multiple lenders at a given point of time, which leads to better commercials and structure. Uh, uh, Typically, we have seen 50 basis points to 2% reduction in interest rates, quick disbursals. Uh, there is complete transparency on the platform, nothing hidden. You get to decide what you want and what you don't want. Uh, there is a single point of contact from UB for all your needs with the lenders and for the enterprise as well. These are just a few of the enterprises, across segments that you're working with. You have JSW Group, Savix, Kiloska Group. You have a startup. You must have heard about this brand, Wrong, which is marketed by Virat Kohli, Vedanta, etc. So these are the sectors that we have typically covered, and we are adding more and more sectors to the platform. These are about 12 to 13 sectors that are covered on the platform that we currently cater to, and these are sectors that lenders are also seeing a lot of interest from their side. Uh, Companies right from AAA to even unrated companies are being catered on a platform. This is one case study. On request, we can share more case studies with you. You might have heard about this company, Zetwork. They are a marketplace for manufacturing. So what Zetwork does is that it will take large orders from from large corporates and leverage multiple suppliers in the country to fulfill those large orders. Right. So one problem that this company was facing was that they had received a large order from one of their customers. Uh, Theoretically, let's say Mintra, they had received a huge order from Mintra for manufacturing jeans, right? What will happen is that given the pricing power or given the cloud that a large corporate would have, right, it would not give advance money or advance capital to any company to fulfill that order, and the order needs to be delivered within 60 days. But what will happen is that since the vendors of this company would be SMEs, right, they wouldn't have such kind of capital on day one, and without capital, they wouldn't be able to start the work. Uh, so here, a vendor solution financing program about 200 crores helped Zetwork to complete the order on time and efficiently manage its working capital needs and to fulfill the order. So what happened is that this company tied up tied up with a lender to the platform. Um, Suppliers of Zetwork got funded on day one through purchase orders and invoices, and on the due date, this money was paid by Zetwork to the lenders. So essentially, this company got 60 days worth of credit. It was able to extend its creditors or working capital by about 60 days and able to fulfill the order. I'll just skip this. Yeah, this was all about UB and on what we are doing on the supply chain side of things. Thank you.
Thank you, Mr. Biani, for the wonderful presentation about the UB. I would like to urge all the SMEs, those who are present over here, to take advantage of the various services provided by UB and leverage their credit ratings to secure better terms and conditions. And the whole UB team is here today. So post this hour, you can meet them and you can discuss with them in detail. Uh, so now one of the key factors that influences the availability and cost of finance and for SMEs is their credit ratings. A credit rating is an independent assessment of the creditworthiness of a borrower based on its past performance, current financial position, and future prospect. A credit rating helps lead lenders to evaluate the risk and returns of lending to a borrower and accordingly decided on the terms and conditions of the loan to address this. I would like to invite Ms. Sakshi Suneja, Vice President from ICRA Ratings, and she will be talking on the criteria and methodology of corporate ratings.
Hi, good evening, everyone. As ma'am told, I'm Sakshi Suneja. I'm Vice President and Sector Head at ICRA Limited. I've been working in the corporate ratings for the last 12 years. And today I'll be giving you my opinion and I'll be presenting ICRA's rating methodology for rating manufacturing companies. Sorry. So we'll start by giving a brief overview of the group ICRA, and then we'll move on to discuss the building blocks of the ICRA's rating framework. And then we'll further delve into the understanding of the detailed parameters that drive the business risk, financial risk, and the management risk. So ICRA is one of the premier rating agencies in India. It has a strong vintage. We have been in this industry for more than 30 years. We were set up in 1991 by leading commercial banks, financial institutions to provide an independent view on the credit ratings in India. Currently, we are a subsidiary of Moody's Investors Service Company. ICRA, along with its subsidiaries, which include ICRA Nepal and ICRA Analytics, form the ICRA Group. Today, we offer a gamut of services spread across research and rating. So, we have current live ratings of more than 3,000 issuers, and we have rated more than 65 trillion worth of debt. In ratings, we apart from the corporate debt ratings, we offer other rating services like infrastructure ratings, mutual fund ratings, public finance ratings, InvITs ratings, and structured finance ratings. Apart from rating, we also have research services where we cover more than 55 sectors and we offer in-depth and real-time insights on these sectors. Other than the sectors, we also offer detailed coverage on our perspective on the economy. And apart from this, for the rated issuers, we also offer detailed credit perspective reports. So, what is the use of a ratings? What is the use of the ratings that ICRA assigns? So, the ratings that ICRA assigns help investors in making informed investment decisions, and for the issuers, it helps them in optimizing the cost of funding, and also provides them access to various funding options. As I mentioned, apart from the ratings, we also offer various research services. We have a coverage on more than 55 sectors where we provide in-depth and real-time analysis. The research are themed on are provided on relevant credit themes which are actually very useful for banks, mutual funds, insurance companies, and venture funds. We also offer detailed credit perspective reports to provide the lender or the investor insights into the company's credit profile. We have many first credit to ourselves. We have ICRA has rated India's first covered bond. We have a significant presence in rating of InvITs and REITs. We have significant presence in the various structured product ratings. We have also rated various securitized and collateralized transactions. Now moving on to understanding the building blocks of ICRA's rating framework. Before we proceed to this, I think it is important to understand what is a credit rating. What does a credit rating mean? A credit rating is an opinion on the relative probability of an issuer to meet its obligations on time. The focus here is on the timely payment and not on the ultimate payment, which is the focus of the banks. So here we follow a forward-looking approach to understand whether the issuer will be able to generate adequate cash flow from operations to fund its debt servicing obligations in time or not. These are assessed not only qualitatively but also quantitatively. So we have basically divided the entire framework into four segments. We start with the industry risk, we move on to the business risk, the third is the financial risk, and the fourth part is our view on the quality of the management. All these four parameters, they form the base rating of an entity. These ratings are subsequently uplifted or corrected depending upon the kind of the parent group that an entity is part of. These factors then determine the final rating. Just a caveat here, the framework that I've shown here is a general framework, and the business risk that we have identified are the broad parameters that we look at. These parameters further get refined and fine-tuned depending upon the sector that which we are rating. For example, if an entity is into a metals and mining sectors, the business risk would include factors like the location of the assets, the kind of installed capacity and the utilization that it has been having, what kind of backward integration does it have, and what kind of technology access does it have. But the broad contours will remain the same. So we'll start with the industry risk. Now, industry risk basically has four factors that includes growth prospects, cyclicality, competitive intensity, and the exposure to regulatory risk. Now, when we analyze an entity, we look at the kind of growth prospects that the industry is facing in which the entity is operating. An entity which is into a sector which has higher growth prospects has better chances of earning higher rates, higher returns and profits than an entity which is in a declining industry. Second factor is cyclicality. Now, cyclicality can arise on account of two fronts. One, the fortunes of an entity can be dependent upon the fortunes of the economy. The classic example here is that of an automobile OEM. And the cyclicality can also arise on account of the volatility in the commodity prices. The classic example here is that of a steel industry. Now, in both of these cases, the profits of the entity are volatile and that can impact the debt servicing ability of the company. As against this, if an entity is operating in a stable industry, the cash flows of that entity are more predictable and can lend support to its credit profile. The third factor we look at is the kind of competition that is prevailing in the industry. If an entity is operating in a highly intensely competitive industry, the ability of an entity to improve its revenues and profits will be limited. This could arise because the industry is highly fragmented, has low entry barriers, high exit barriers, or there exist several supply restrictions. The fourth facet that we look at here is the regulatory risk. Now, here, what we are trying to analyze is basically how is the competitiveness of the industry getting impacted by the measures taken by the government. If the government increases the level of taxation, or if the government imposes a supply ban or reduces the level of subsidies or the rates, how is the competitiveness of the industry getting impacted, and if it is getting impacted. So, all these factors, they determine the industry risk. We now move on to the business risk. Now, from the more macro perspective, we are now moving on to the micro perspective. Under the business risk analysis, we understand about the business model that an entity has. If an entity has a stronger business model, that would lend support to its cash flows and could lead to a relatively low credit risk. Now, this could arise on account of three factors. We'll start with the first one, which is the competitive position. Now, competitive position basically implies the ability of an entity to ward off or exclude competition to the extent and as long as possible. This could manifest in various forms. An entity could benefit by virtue of having a larger scale, which could be in terms of large installed capacity or a large revenues, or could have a strong market position. An entity could benefit by having strong pricing power, a strong brand in the market, or having access to a patented technology. For an entity which is operating in a commoditized industry, the competitive position arises by virtue of its cost structure. If the cost structure is favorable, or if the entity has access to a favorable distribution network, or has access to key suppliers or customers, that can lend support to its overall competitive position. The second factor that we look at here is the diversification. Now, when we are talking about diversification, this axis basically on four parameters: the customer diversification, geographical diversification, product diversification, and the supplier diversification. An entity which is scoring positively on these fronts has a better chance of surviving an industry downturn other than industry downturn in comparison to an entity which has exposure to limited number of customers, limited number of geographies, and limited number of products. So this entity, the cash flows of this entity would hence be more volatile. The third factor that we look at is the quality of assets. Now, when we're talking about the quality of assets, we basically look at the quality of debtors that an entity has on its balance sheet, the kind of an inventory holding that it is enjoying, and what is the kind of fixed capital intensity that it enjoys. I'll start with the debtors. Now, when we're talking about debtors, herein we are looking at an entity's exposure to counterparty credit risk. What is the debtor concentration in its balance sheet? What is the debtor aging? Are there any overdue debtors? And if yes, what is the entity's plan on recovering it? If an entity scores unfavorably on these parameters, that means an entity is exposed to risk of bad debts or write-offs, which can impact its debt servicing ability and the liquidity position. Next, we look at is the inventory holding position. Now, when we look at the inventory holding position, we are cognizant of the fact that the inventory holding varies from industry to industry. For example, a cotton spinning industry. Now, we know that the raw material requirements of a cotton spinner is highest in the month of March and lowest in the month of September. As against this, if I were to take an example of a rice miller, A rice miller is structurally required to hold larger inventory throughout the year, given the nature of its business. So, when we are analyzing the inventory holding position, we first analyze the kind of industry in which an entity is operating and how is the inventory holding position of the entity relative to the peers in that industry. If an entity is holding larger inventory vis-a-vis its peers, then that could be a cause of concern because that would expose an entity to risk of inventory write-offs in case the final prices decline. However, if the inventory is backed by confirmed orders, that is a different situation. The third factor we look at is the fixed capital intensity. Herein, we see basically the OI, the operating income to gross block ratio, and how does that compare of one entity with the other. If the OI to gross block ratio is higher for an entity, that means vis-a-vis the peers, that means the entity is able to utilize this gross block more effectively vis-a-vis an entity which has a lower OI to GB ratio. This is just a snapshot of how we assess the business risk. The factors that we look at, the parameters that we look at are scale, market position, pricing power, and diversification. And herein we rank the entities from weakly positioned to strongly positioned, and in between we have a mid-sized player. Just a caveat here, uh, this does not mean that if an entity which scores low on, say, scale, if an entity has lower scale of operation, will that entity have higher credit risk? Not necessarily. If an entity has a lower scale of operation but scores positively on the fronts of market position, has a good pricing power, and has access to a good set of customers and specific patented knowledge, etc., which bolsters its business position, then that lower scale of operation does not invariably constrain the rating. We move on to the second parameter, which is the financial risk. Now, when we are analyzing the financial risk of an entity, we look at the past performance of an entity. So we look at the past 5 years of performance of the entity to see how sustainable has the performance been. And we also look at the future performance. So we estimate the cash flows of that an entity would generate, say, over the next 3 years, and judge the adequacy of those cash flows to meet its capex requirements and debt service obligations. So here the parameters that we look at include profitability, leverage and coverage, and the third one is liquidity and cash flows. I'll start with profitability. Now, when we are talking about profitability, we are not just looking at the level of profitability, but also the stability of profitability. The entity has to demonstrate that it has the ability to generate and sustain those profits over a period of time. So this is driven by the sector in which an entity is operating. So we look at the ratios like operating profit margin, net profit margin, and pivot margin, which is a very relevant ratio that we look at for manufacturing companies. Only return on capital employed is sector agnostic because it is capital structure agnostic. The next factor that we look at are the leverage and coverage. Now, when we're talking about leverage, we are basically trying to gauge the entity's dependence on borrowings and how levered the capital structure is. If the capital structure is lowly levered, that means if an entity has lower reliance on external borrowings, that entity has better financial flexibility to weather the risks. The key while gearing, which is total debt to tangible net worth, is a very common ratio. The rating agencies generally look at the total indebtedness ratio, which is basically the ratio of total outside liabilities vis-a-vis the tangible net worth. Why? Because other than the debt, the entity has other forms of funding its working capital requirements. This could be in the form of non-fund based limits or creditors. To gauge an overview of the overall total outside liabilities of the entity, we look at the total indebtedness ratio. Next, we also look at the coverage, which is basically the adequacy of profits to service the debt obligations. The ratios that we look at include interest coverage ratio and the debt service coverage ratio. We also give a fair amount of attention to liquidity and cash flows, which is basically the ability of an entity to meet its short-term obligations from various internal and external sources. Now, when I'm talking about internal sources, I mean the cash flow from operations that an entity is generating. And when I'm talking about external resources, the kind of funding lines that an entity has access to. The ratios that we look at include current ratio, working capital cycle, which is basically the ability of an entity to convert its net current assets into cash, and the other standard cash flow ratios, including fund flows, free cash flows, and retained cash flows. Now, this is a snapshot of the way in which we assess the financial position of an entity. So we have ranked the various parameters that we look at, which include ROCE, indebtedness ratio, debt to profit ratio, interest coverage ratio, and the DSCR. Herein, we rank the entities on various parameters, and we rank them as weakly positioned and strongly positioned. Again, just a caveat, these are indicative financial matrices. An entity which scores, say, low on ROCE but scores positively on the other parameters, has a strong business profile, or is a part of a stronger group, could have a better credit risk profile. So these are only indicative financial indices. Now we come to a more softer aspect that we look at, which is the assessment on the management quality. Now, while assigning the ratings, we hold detailed discussions with the management to understand their overall approach towards the company. How experienced is the management? What is their level of commitment towards the company? Are they very conservative or are they very aggressive? Do they have large capex plans? Are they prone to debt funding or not? Or they are very conservative in taking additional debt? If they want to launch new projects, how has been their past track record? Have they been able to turn around the projects, or those projects have been exposed to time and the cost overruns? So these factors are judged more qualitatively, and that is why we hold very detailed discussions with the management to understand the overall approach towards the company. Now we move on to the last segment, which is the other considerations. So the other factors that we look at include the project risk. For example, if an entity is a project-sized entity, does the entity have achieved the desired financial closure? Is the entity in a position to execute the entire project within the budgeted time? Is the entity relying heavily on short-term borrowings and is thus exposed to refinancing risk? These are the important questions that we ask when assigning the rating. The other three risks, foreign currency risk, contingent liabilities, and parentage and financial flexibility, are self-explanatory. I'd like to spend a minute on the last risk, which is the environmental, social, and the governance risk, or the ESG risk, which is now a more evolving kind of a risk that we are analyzing. While ENS, which is the environmental and the social risk, these are in the industry driven, governance risk is entity driven. Now, when I'm talking about governance risk, we look at the overall corporate governance of the entity. What is the level of disclosures of the entity? Does entity, if it's a listed entity, does it have a fair representation of the independent directors or not? And whether the independent directors have a voice of their own or not. When we talk about environmental and social risk, we assess these risks more broadly. We assess the kind of risk, direct or the indirect, that an entity is exposed to, and how does that entity intend to mitigate these risks. For example, I'll take the example of a steel manufacturing entity. Carbon transition risk is one of the most prominent risks which the steel sector is facing. Given the high dependence on fossil fuels, there is a lot of pressure on the steel industry to move to renewable sources. But this is easier said than done. This will entail significant cost for the industry. And what are the management plan on and how does the management plan to deal with this? That is how we analyze the environmental risk. In case of an automobile or OEM, the change in technology is a very prominent risk that is arising because of electrification of vehicles. How does an auto OEM plan to tackle this? These are the questions that we ask while dealing with the ESG risk. Well, this brings me to the end of the presentation. I'll be happy to take any questions. Thank you for patiently listening to me.
Okay, now I think there is no question, so everybody is hungry. So we will like thank you everyone for joining this event, and thank you UB for supporting us to organize this event. And we have circulated feedback form, so please fill that, and while going, please submit that on the registration table. And I would like to say thanks from SME Chamber of India for joining this event, and please join for dinner. Thank you. Thanks a lot.